According to the Federal Reserve's latest survey on consumer finances, homeowners have a 44.5 times larger net worth than renters. That's as of 2016. The median net worth for homeowners was $231,400, which was a gain of 15%, compared to only $5,200 for renters. This comparison clearly shows the power of home ownership in building wealth if you want to gain financial freedom. Home ownership is a no-brainer. Buying a home is the smartest thing you can do to help build wealth for long term. Now, I know there are people that say there are pros and cons, and of course there are, to renting versus buying. That's what we're going to cover today. I'm Jason Swanson, your Community Mortgage Pro. Let's take a look. And when we look at rent over the last, let's say, 23 years or so, this has a y-axis of amount, and then X is going to be just time. So from 97 to 2020, this graph looks just like this. Maybe a little bit prettier. So ultimately, rent is going up every single year. If we look at home ownership, yes, it has its downfalls too, but if you look at it over the last, again, about 23 years since this study was done in 97, we've got home values, right? And then we have time, essentially. So home values and time. This one starts off back in 1997, right? So if you bought a house in 1997, you would have saw your house start somewhere off around $80,000, let's say in this instance, for this median graph. It comes up, it staggers a little bit. Okay, that's understandable. It goes up into the 2005, 2006, 2007, kind of hits a nice peak. And then we see that crash that comes down that we all got a little fearful of. Now, some of us, of course, might have bought there, and that might have been a little painful for a little while. But see what happens is that now we have, on this continued chart, over the next 10 to 15 years, we're seeing this incline again. So today's prices are back up for a win. That is an increase over 23 years. That is your equity. That's building wealth. Rent, remember that one? You're paying someone else's mortgage. You're giving them all your money. October 27th, 2020, the Census Bureau announced the following residential vacancies, the homeownership statistics for third quarter 2020. Now, the homeownership rate was 67.4%, was actually 2.6% higher than the third quarter of 2019. So again, 67.4%, and then 2019 was only 64.8%. That's a pretty good difference. That shows that people are buying homes in the last year to 2 years. And statistically, not that much different than the second quarter of 2020 at 67.9. So 2020 was a pretty good year for home ownership and growth. Approximately 89% of the housing units in the United States in the third quarter of 2020 were occupied. So that means, you know, that difference of homeowner occupied versus a home is owned and it's rented out to someone. Those residential homes at 89.9% of the housing units in the United States were occupied, and only 10% were vacant, 10.1. So owner-occupied housing units made up 60.6% of the total housing units, while renter-occupied units made up that remaining 29.3. 80.7% of homeowners or owners over 65 were homeowners, and the lowest for those householders under 35 years of age was only 40.2%. So you see that large gap. That is over double. People over 65 have an 80.7. So over 65 years of age had an 80.7% home ownership. Under 35 only had 40.2. This is why Obviously, as you get older, hopefully you get wiser and you decide to invest in real estate. So in every about 9-year gap, so under the age of 35 was the absolute worst at 40.2% own homes. And then it goes to 35 to 44 is the second worst. And then 45 to 54 is essentially the third worst or third best. And then 55 to 64 years of age was the second best. Race in America, or homeownership rates by race, the third quarter of 2020, the non-Hispanic white alone householders reported a single race, non-Hispanic white alone households, 75.8% owned a home. The rate for Asian Americans, so Native Hawaiian, Pacific Islander householders was second at 61%. And then the rate for Black-owned householders was lowest at 46.4%. So there really is a lot of opportunity across the board with various programs and down payment assistance and just simply education and videos like this to help people understand the home buying process and the value of home ownership. A couple advantages. I've rented before. I think we all have rented. Rent payments could potentially be lower. Repairs aren't your responsibility. Well, that's huge. I remember being in a rental and the sink would get clogged or the dishwasher would stop working. There'd be a leak from overhead. It doesn't matter. Somebody else is going to come take care of it. That was always pretty cool. Flexibility is probably the largest, especially with the younger. If you see the, oops, forgot an L, forgot an I, you don't feel like you want to have your feet planted somewhere, which doesn't mean you can't invest in real estate properties for investment, right? So flexibility to get up and go as you want every 12 months or so. And then ultimately, cost. So sometimes, I suppose, it's a little bit cheaper upfront to get in lower upfront costs. So instead of, prepaids, closing costs, down payments and all these things, you just have to worry about perhaps, 1 month upfront, security deposit, maybe some money for a pet. So it's could be considerably lower, but again, you may be surprised with some of the programs out there. Now, if we go on to the rent disadvantages, well, rental payment may exceed your monthly cost of the mortgage. So that's when I talked about that sometimes people are surprised they're paying $2,100 in rent and they could actually get into a house with, let's say, $1,500 to $1,800 in a mortgage payment. And that includes escrows. And payments never stop when you're renting. So at least when you buy a house, you know that 15, 20, 30 years, that is a goal line, right? That's the finish line. Now there are some times in there where you might home equity or refinance and move that around, but ultimately you know that there's an end game, there's a goal line. But when you're renting, there is no real goal line unless it's to buy a house. Renting, you're not going to see any tax benefits. Right? So I think that's pretty clear. You have no interest to write off. A little more limitation in regulation and rules, generally speaking, when you're looking at renting. And of course, it's considered more temporary. So it's not as stable. It's less stable of an environment. Neighbors come and go. Again, you're always at the property of the homeowner. So whether you're renting from a large apartment complex or you're renting from that person you're also help paying their mortgage, someone like me who invests in a property or someone like you who could be investing in a property, you're ultimately at their mercy. So that can be a little unnerving. All right, so let's go and take a look at home ownership advantages. So you can build home equity and wealth, and obviously over time, even if the first few years is predominantly interest, hey, well, that's okay. At least you're still putting a smaller percentage. It might be 90% towards interest, but guess what? That 10% is still going towards principal. It's still building equity. So again, remember when we saw that home value chart, right? Kind of a rough picture here. If I'm buying this property somewhere in here, and sure, I'm paying a lot of interest. Well, guess what? Even the amounts that I'm paying in principal is still going to increase my equity because the home value is going up and I'm paying down the principal. So ultimately, 10, 15 years, 5, whatever the case is, whatever environment you're in, you're going to see that gap start to grow. Okay. So when you have obviously inflation and when you have home growth and values increasing and you're paying down the balance, all of a sudden you're going to start seeing more of that gap and more of that equity growth in your property. So, and the more you continue paying, so at that 10 or 15 year mark, you're going to start seeing more go to principal and more start going to principal. So you also have the flexibility to make extra payments, overpayments. These things will just, it's insane how quickly you can make a 30-year mortgage into a 20-year mortgage if you just make that extra $500 a month. When you can, you have the flexibility to do that. That could be superb in building wealth and reducing the interest paid. So again, ownership, back to sizable tax deductions. Again, depending on married or single and how much interest you're paying. Sometimes points, you can look at that as an investor, talk to your tax accountant, tax attorney regarding those facts and details. The space is yours. You can have pets, right? It's your rules. The ability to remodel, expand, tear down. Sure, you might have a homeowners association that could be a little bit of a thorn in your side, but hey, if you want to put a deck on the house, you can do that. Put a fence up, you can do that. You have the ability to do that on your own. Potentially better for children in the family structure, right? We talk about stability. We know that if you're moving around every year, kids are jumping schools, whichever, they could tend to maybe feel a little more insecure. You know, however that works, sometimes travel can be great. Sometimes it can be a little harder on the family. So sometimes planting your feet can be fantastic for family structure. The mortgage can improve your credit history, your score, of course, if you're making those payments on time. And then ultimately, when I talked about equity, you have the ability to borrow against your home. So you can do a home equity line of credit. You can do a cash out refinance. Again, you're taking your equity out. You're going to use it for whatever you want. You could buy another property. You could send your kids to school. You could buy that nice boat. You know, I don't know if that's exactly wealth building, but you have the ability to do those things when you own a home. You have zero equity in a rental property that you're living in and paying rent. Ultimately, no more monthly payments once the mortgage is paid off. Caveat, you still have insurance and you still have taxes, so you probably pay those annually, but the mortgage itself, after 30 years, typically is going to be gone for you. And fixed payments. So if you choose a fixed mortgage, of course, there are a bunch of mortgage types that you could look at, but you'll have fixed payments. The only, again, caveat to that is escrow balances, because let's face it, your mortgage isn't going to change, but your escrow of taxes and insurance, the tax man and the insurance man, they're likely going to raise a little bit every year, and you'll see the escrow balance adjust for that. But ultimately, your mortgage payment shouldn't see your mortgage shouldn't see any increase, but including those escrows, you'll see a slight bump or increase in that over time, not nearly as rough as rent. So fixed payments, if you choose, the mortgages are the cheapest loans available, especially in the last year to 2 years. We're looking at interest rates at extremely low interest rates that are saving homeowners so much money long term. So borrowing money is so cheap right now that, again, if you're going to buy a home, now's the time. No landlord. You can exclude capital gains when you sell the property. Again, talk to your tax accountant. There could be windows of time to do that, from if you want to purchase another house, you have a rental property, you're selling that, talk to your tax accountant about those exclusions and those savings. And then, of course, inflation hedge. Houses become worth more as the dollar loses value. So as the Fed keeps printing money, the dollar starts to come down. Inflation hedges increases the home worth, essentially. So the home values are going to go up, and that's essentially forced savings. So if you think about it, every time you're making a mortgage payment and you're paying towards principal, you know, if you have a hard time saving and putting money aside, well, guess what? You're kind of forced to do it. So leveraged investment, can rent it out to others. You know, you can rent out a room. You can rent out a basement. You can help offset a lot of those costs. You can sell and use the proceeds for bigger and a better home, or buying an investment, or whatever we talked about before. And of course, imagine a day 20 or 30 years from now when you no longer have that mortgage payment and you have a retirement nest egg. So yes, invest in stocks and mutual funds and all of those things, annuities. But at the end of the day, if you have a home, it's that forced savings, that amazing growth. It's a proven time and time again. You remember when we saw that one graph that it showed even during the big spike in 2006 to 2009, that whole debacle that we had with mortgages and having to bail out the banks, that we did see a negative there. We saw some losses, but then we ultimately saw an increase. So now that we've gone through most of the home ownership advantages, tailing off with the forced savings and the leveraged investment, and you can rent it out to others, selling and using the proceeds for a bigger and better house or whatever you want, having that retirement nest egg at the end of 30 years, ultimately just investing in your future and living the American dream. Now we're going to look at, well, some of the homeowner disadvantages. So some of those disadvantages, sorry for my handwriting, terrible. You could ultimately overpay for your house. I mean, we've seen that, again, going back to that 04 to 09 period. There was a lot of overvalued properties, and they were just handing out mortgages. So in a lot of cases, there was that time period in which if you bought really high, then you could have seen some losses, unfortunately, unless, of course, you held on to it until now. Because remember, even during that spike, if you held on to it and didn't sell, down here, if you held on to it, you would ultimately see that increase again. So if you sold down here, odds are you probably aren't very happy with the home buying process, but you had the ability to recover and then buy again to improve your chances. So some of those disadvantages, again, not everyone qualifies for the mortgage. Finding a home is a hassle, right? Meeting with an agent, I'm sure you have wonderful agents, but it's time consuming. It's stressful. The house you like is there's offers going out. There's 10 offers on it. It's gone before you have a chance to make an offer. The market right now is super hot, money's super cheap. So a lot of that stress can be part of the process, which can be a disadvantage. And sizable down payments. So, when you talk about moving into a property, rent is a little cheaper. We talked about how buying a house is down payment and closing costs and a lot of other costs. So that's a disadvantage in a lot of ways. And then, of course, the maintenance costs can be a little more excessive. Upkeeping the dishwasher, the leaky roof, having to buy a lawnmower for the first time. There's just certain costs associated with home ownership, which can be looked at as a disadvantage. Pricey HOAs, although they're there for a good reason, to uphold property standards and values, hopefully, they can be rather intrusive at times. If you want to build something on your back, deck, and you have an HOA, they send you through all the rigmarole and have you do all the get your signatures from your neighbors. Anyway, it can be stressful. It can be time consuming. Increased liability and responsibility. So having to shovel your sidewalk, because if neighbors slip or fall on your sidewalk out in front of your house, it could be a liability against you. Those types of things are a disadvantage. And of course, just the transactional costs. So when you go to sell a house, it can be pretty expensive for the seller, because not only are you having to pay real estate agent fees, but you're also potentially having to help pay closing costs. So hopefully you've had the house long enough to appreciate and value enough, develop enough equity to where that's just a smaller portion of your proceeds. The increased liability, the transactional cost, ownership is stressful. I think that really sums it up. Taxes and insurance is something that is never going to go away. Even if you pay off your house, you still owe the tax man and the insurance man, rightfully so. And then, of course, hurricanes, ice storm, snow, tornadoes, whichever, you're ultimately responsible for it. So, home damage, a tree falls on the house. I had that happen in a property I had in Utah. It can create those challenges. So you can also be foreclosed upon on your property. If you don't pay your mortgage, after a little while, you're going to have late fees showing up, obviously, and then you're going to have potentially your house foreclosed upon, which, depending on your financial situation, could sit there for 7 years, 10 years. So those types of negative blemishes are tough. Now, after all that, after all the stats and all the pros and cons, let's take a look at what's next. Because this is really what's important about this video today. Is ultimately, if you're looking to buy a home for the first time, or let's say second or third time, you know, it's almost like buying a business or starting a business. You have to do certain things to make that happen. And defining what's affordable to you. So looking at your budget, to find out what's affordable to you, and determining if you want to be, you know, in a big, beautiful house that takes up most of your income, or if you want to be more modest and save money for travel and student, you know, children's education, defining that budget. Number two would be kind of understanding your credit. And I can't tell you how often I speak to someone who thinks their credit score is amazing, or they think it's in the dumps. You know, I had one borrower that thought their score was 575. And I think it was, obviously, at some point. But when we went to go check it again, it was 780. 575 to 780. They had been doing all the right things, just didn't pay attention. So I had another borrower who told me their score, they swore up and down it was 820, 820, 820, 820. We went to go pull credit, it was like 640. So again, you know, it's so important that when you're thinking about buying a home, is to, you know, start that process with a loan officer, a trusted loan officer, to pull the credit, check your liabilities, check your ratios, run some numbers, check your credit, and just kind of work that out for you. Now, you can always pull your credit as well and look for it, but understanding your ratios and understanding how that applies to a loan is a little bit trickier. And then if you need a little help, you know, hopefully the loan officer is skilled enough. If it's a 20 or 30 point bump, there's some short-term things. By short-term, I mean things that you can do, you know, in the next 30 to 60 days that could potentially boost your score, and we can help guide you with that. Generally speaking, bigger gaps might require more of a professional service, because it can be a lot of information to cover and a lot of consistency to work on building credit. So choosing the right mortgage type. You know, throughout this lesson, I've probably thrown out USDA or FHA or VA or ARMS and interest only and all these different mortgage types and abilities and qualities of a loan. You really want to find the right one that's good for you. You know, if you have a lot of cash and great credit, you know, conventional might be the way to go. If you want to move in a semi-rural area, you know, outside the city limits, and it qualifies, and you have limited down payment funds, or you have some cash but it's only for hopefully closing costs, and we'll get into all that. You know, you might look at USDA. If you have credit that needs some growth, and some opportunity there, but you meet some kind of minimum standards, there might be FHA programs. So really just figuring out what's going to work best for you, not just short term, but long term, would be very important. And then, of course, choosing the right down payment. So again, as I just mentioned, a lot of times people, you know, they might have 20 grand in the bank, and that's it. So they say, well, I can put down 20 grand. Well, I love the enthusiasm, you know, I love the spirit behind that, but there's still going to be closing costs associated with purchasing a house. So closing costs are going to include things like processing fees, application fees, origination fees, points, buying down that interest rate. It's an option. It's going to include title fees. So it's the legal process of transferring, you know, a deed or the property from one homeowner to the next. There's a lot of behind the scenes that go on with that, with the title company. You know, there's governmental charges, county charges, and then another big one that we'll dive into is prepaids, so escrows, taxes and insurance. Again, there's a little more involved. So let's say out of that 20 grand that this person had, they may only want to use 5 or 10 of that. You know, whatever the minimum down payment is for that first-time home buyer, that second home-time buyer, could be 3, 3.5%, 5%. We can look at that and determine what do we need for closing costs. Can the agent negotiate, you know, seller assistance, those things. There's options, but ultimately there's different things we want to use this money for. Not to mention even holding reserves. Because of COVID, a lot of down payment assistance programs require 2 months reserves. So we want to make sure that we have that available out of that 20K. So now we need to look at how we best utilize the funds that we have, how we can get additional funds, how we can get seller help, all those things. Anyway, understanding the down payment that's right for you and what's involved there. And then, of course, understanding the difference between the correlation with interest rate and points. So easy enough with down payment assistance programs. The counties in the state generally have flat interest rates, can't charge any points. They tend to be slightly higher interest rates if you need funds, right? There's no free, as my boss always says. So you'll have, if you want down payment assistance, you're generally going to pay a little bit more on the interest. Now, interest and points, you have the option if you go any of these other loan types to essentially effectively prepay interest. So you can pay upfront if you have the funds, or have the seller, in some cases, help with some of that closing costs on points that help reduce your interest rate, which effectively reduce your interest payments over the course of your mortgage. So again, understanding the difference there. And then choosing the right mortgage, of course, we talked about that, what's going to be the best fit for you, and then ultimately avoiding pitfalls. So I have people who, you know, buy a home or buy a car, you know, after they've tried to qualify for a mortgage, everything's good, they go out and buy a car because they're excited, they started spending, you know, mentally started spending money, they feel great. Well, that can be detrimental. You know, there could be quitting your job. I mean, there's just sorts of things that you don't want to do, opening lines of credit. Discussing those pitfalls and handling those problems beforehand, and then staying as clean as you can throughout the home buying process, and avoiding all those pitfalls that can happen, missing any payments. So I wanted you to know that when I do my data research, you know, I used a lot of good resources, and I used moneygeek.com. That's a good one for some statistics and pros and cons. I used truthaboutmortgages.com. I went through Investopia.com. I looked at Mortgage300.com, and then of course, you know, the U.S. Census Bureau and the U.S. Department of Commerce were some big tools for me. And I want you to have the ability to go on those sites, reach out to your trusted loan advisor, your mortgage loan officer, get these questions answered, and start considering if home growth and wealth and equity, home ownership is right for you. So again, Jason Swanson, your Community Mortgage Pro. Thanks for tuning in. Tune in next time as we discuss the home buying process in depth. Thank you.